Hi, so welcome to the stream today. Really excited for having you once again on our Q&A session as I help you and assist you and provide you with some answers to your questions so you can prepare well for the December 2022 examination. And I see some of you guys joining. You are welcome. This is a Q&A session. I'm going to be answering your questions. So any questions you have, something you would want me to share my thought on, a topic that you are having a challenge with that you want me to talk about and provide you with some clarity on, put it in the comment section, put it in the chat. I want to hear from you. And also, if I will be sharing some thought with you on some of the key issues, the structure of the various papers as much as possible so you can prepare well for the examination and most importantly pass the examination. So welcome to the stream today. Really excited. See some of you guys joining. You are welcome. A thumbs up on the video and put in the comment section for me any questions you have for me, something you would want me to share my thought on, something that you would want me to talk about to assist you in order for you to prepare well for the examination and pass the exams. Remember that we having copies of our books available that you can get access to. So we have all these books displayed on the screen available. Taxation in Ghana, financial management, corporate reporting, financial reporting, advanced audit and assurance, public financial management in Ghana. All these books are available and you can get access to them. You can WhatsApp the number scrolling below the screen 0501149296 and we can assist you. I see some comments coming in. Remember, it's a Q&A session. So really, I want to hear from you guys. Whatever questions you have for me, something you would want me to share my thought on, don't hesitate. Put it in the chat for me and I want to hear from you. So let's see some chats coming in. Hi, Nhyira. We are having our exams this we are having our exam next week. I must confess, your lecture has really helped me a lot. That's great to hear. And that is from Kehinde Oyin Lola. I wish you all the best as you go into your examination. I think that is ICAN instead of Chartered Accountant Nigeria. I think so. So wishing you all the best as you go into the exam hall. Kiendi, I hope I mentioned the name right. Kiendi Oyin Lola. Then is it from Nigeria? Okay, so that's the Institute of Chartered Accountant England and did I say England and Wales? Institute of Chartered Accountants Nigeria. So wishing you all the best as you go into the examination. Edward Sikambali. Okay. Edward Sikambali. I thought it was like Edward Sikampedide. Okay, so Edward Sikambale. He said, how are you, sir? Your videos help me a lot. I am sure I will pass Ziga exams this December. Awesome. Wishing you all the best in your examination. And I'm really excited. And it's a privilege that our YouTube channel is able to provide you with the content that you need to pass the examination. So once you are getting value from it, make sure you practice a lot of questions. It's very important because it's always one thing to understand the principles that underline the various topics, but it's another thing when you are before a question. So you need to ensure that you practice a lot of questions to test yourself to know that really you understand what the various topics actually is and what they are talking about. So, yes, in as much as you have watched the videos, you understand the principles, you must solve a lot of questions to put yourself in the position to pass the examination. Okay, so that is it from Edward. Wishing you all the best in advance for your examination. Ebenezer Mensa, it's giving us an emoji in the chat. Thank you very much. I see some of you guys joining. This is a Q&A session. So any questions you have for me, something you would want me to share my thought on, don't hesitate. Put it in the chat for me. It's a Q&A session. So hit me with as much as you can, whatever topic it is. Hopefully, I will be able to provide you with some answers here. In that case, Tankoba Sita said, hits more on deferred tax. Okay, so let me bring up my screen quickly and let's see what we can do. So it means that's my first question coming up. Let me get my screen properly organized here. Okay, let's go. So Sita is saying we should hit on Ebaze deferred tax. Okay, so that is IAS 12. Okay, IAS 12, and it's talking about deferred tax. This is one of the fundamental standards if you're writing financial reporting, corporate reporting, that you must know about. It's very, very important. Very, very important. Now, so since CETA wants me to talk about deferred tax is simply the determination of the future tax consequences of a transaction. So the reason why deferred tax comes in, it's because transactions, okay, transactions or events are accounted for separately by an entity or the entity from how it is accounted for by the tax authority. In other words, whilst the entity will be thinking about the carrying amount of the item, the tax authority will be thinking about the tax base of the item. So it means that and the entity is going to be applying what you know as IFRSs, the accounting standards, but the tax authority doesn't know about IFRSs. The tax authority has to deal with the laws or the tax provisions. Now, when we talk about the tax base of an item or an element, it simply means that the amount that is attributable to an item for tax purposes, the amount that is attributable to an item for tax purposes. So the way the entity will be carrying it, whilst the entity is applying IFRS, the tax authority will be applying what? The tax provision. So what is going to happen generally is that there is going to be a difference between how the item is being carried by the entity in their books in accordance with the IFRSs and how the tax authority is carrying it in its books in accordance with the tax provisions. The difference between these two is what gives us what we call the temporary difference. Okay, the temporary difference. TD. So the temporary difference is going to be the difference between the carrying value of the asset and the item and the tax base of the item. Technically, the carrying value of the item and the tax base of the item. Now, note that the temporary difference can be in two folds. Either we are having taxable temporary difference or a deductible temporary difference. A deductible temporary difference. Now, what you have to note is that with taxable temporary difference, it results into what we call deferred tax liability because it means that the entity is carrying the item above the tax figure. So this results into deferred tax liability. So there is a taxable temporary difference when the carrying value is greater than the tax base of the item. Then there is going to be deferred tax liability, future consequences on it, usually in the asset class. Then when there is deductible temporary difference, that results into what we call the deferred tax assets. That results into deferred tax assets. And when this is present, when the carrying value is less than the tax base, it means that the tax authority is carrying the item above what the entity is carrying it at, and for that reason we will receive a deduction, and so that results into deferred tax assets technically. Now, so that is the principle about deferred tax, but really you have to understand that the deferred tax has various implications for it to be applied. For instance, deferred tax has an implication when we revalue assets. So there is IAS 16 property, plant and equipment, PPE, where we revalue assets. So when we revalue assets, there's a deferred tax implication of it that you must know about. Not only that, number two, when an entity, for instance, engages in how do we call it? Share-based payments. This is for corporate reporting students, and the company offers some share options or whatever it is. There is a tax implication of it, and usually share options result into deferred tax assets because it is a future expense that we want to incur. Not only that, deferred tax has an implication between on IAS um let me bring the standard up. So 16 to IFRS 2. Then the deferred tax also has an implication on an item that I want to bring up. There's another standard that I want to bring up, IAS 28. That is investment in associates. There's a deferred tax implication on that. Okay. Then there are other scenarios depending on the context of the question. Depending on the context of the question. So, Sita, your question about deferred tax, since you are doing corporate financial reporting, will be generally relating to PPEs when assets are being revalued and being dealt with. And so, in that context, whatever amounts that we have, it'll either be going into the P&L or be going to the OCI depending on the context of the question. So that is basically the principle that we have to understand when it comes to dealing with, deferred tax. Okay, when it comes to dealing with deferred tax, maybe we would have to pull up a question and see how it works generally, and we'll be looking at some questions during our question sessions in class and during our revision sessions as well about these. And we will bring some of these things up again in the discussion. But that is the principle about deferred tax. Okay, that's the principle about deferred tax. Let me know if that is clear for you. Olumide said, "Good evening, sir." Good evening, Olumide. Please, are we supposed to allocate impairment loss to inventory also? Um, then there's a follow-up. He says, I meant on disposal group. Um, Inventory, yes, can suffer an impairment. Because when, as per IAS2, inventory should be carried at lower of cost and net realizable value. So if it is a disposal group and it has suffered an impairment, yes, it's likely that we can allocate impairment to the inventory because, but it all depends on the context of the question, usually. Because we can have an inventory, the whole business may have suffered an impairment as a cash generating unit, but the inventory might have not suffered an impairment. The reason is that we have the inventory and we could still sell it at the price that it has to sell. Did you get the idea? So let's say we are a phone, we sell phone, we are a phone shop, and we sell phones. So let's say that we are maybe in the market, we sell iPhones, we sell Xiaomi, we sell Samsung or whatever the heck we sell, and then something happens, we need to close down our shop. I don't think we will say because we are closing down our shop, the stocks of our iPhones value has reduced. So the best bet is if it is not in the question directly that the inventory has suffered an impairment, then we may choose not to allocate impairment to the inventory. Are you getting it? Because the fact that the business is suffering an impairment might not mean the inventory has suffered an impairment if the inventory had not damaged. But if the inventory has damaged and cannot be sold for the amount that we normally sell it for, then it will suffer an impairment. If not, then we wouldn't allocate impairment to the inventory in that context. Are you getting it? Because it's the application of the accounting standards in the context that it suits in. So let me know if that is clear for you, Olumide. Sita said, "Thanks, sir. Always a pleasure. I see some of you guys joining. You are welcome. This is a live Q&A session. So, hit me with whatever questions you have as much as possible. I'm going to be providing you with some answers to assist you so you can do your revision very well and go to the exam hall and pass the examination. So give us a thumbs up on the video. Share the video also. Let's get as many people joining the stream as possible." Then we have Stephanie Ampoffel. Okay, so Stephanie Ampoffel said, "Can you kindly touch on budgetary analysis and evaluation and analysis of public financial statement?" I think you're talking about budget variance analysis, if I'm right, Stephanie. If that's what you're talking about in that context. Because when it comes to evaluation of financial statement in the public sector, there are three things that the examiner is going to be talking about. So, evaluation of public sector financial statements, there are three things. We have the common size analysis, pretty simple there. So, we have a common size analysis. Then we have the ratio analysis. Only one of them will be in the exam hall for your information. And then we have the budget variance analysis. So, since your question is on the budget variance, I think so. Let me talk about it. Now, the budget variance analysis, it simply has to do with looking at the difference between how much has been budgeted for and how much we actually realize for the period under review. The objective of the budget variance analysis is that it is in line with the first pillar of the PIFA framework. It is in line with the first pillar of the PIFA framework. The first and then I think the third pillar of the PIFA framework. Because when we are doing budget variance analysis, we are assessing the budget reliability of government. Okay, and also we are assessing how government is able to implement the budget. Implementation of the budget. So our goal usually, that there are other objectives in it, but keenly we are looking at the budget reliability. In other words, when does government or is the government having an efficient budgeting system in place, and also is the budget implemented as intended? Is the budget implemented as intended? Is very important. Is very important in that case. So when we are calculating the budget variance analysis, we will do the calculation like this. We're going to bring the budget, we subtract the actual, divide it by the budget, and we multiply that by 100. So our answer will usually be in percentages. Our answer will usually be in percentages. So the data will be given to us, and based on the data given, we are going to be calculating the item or the analysis or the percentage change for each of the items. Revenue items may be given, expenditure items may be given. Sometimes the examiner will bring only revenue items or only expenditure items. Whatever the examiner gives us is what we are going to be calculating for. But you got to understand, sometimes the examiner is going to be giving you the original budget, the revised budget, and the actual results. Okay. Please note, as always, that we are going to be comparing or working with the revised and the actual budget. The reason is the difference between the original and the revised is because of the mid-year budget review. Okay, the mid-year review. If you're a student who understands the rules established in the Public Financial Management Act, it is required that at most by 31st of July of every in the mid-year, the finance minister is supposed to go to parliament and brief parliament on how government has implemented the budget for the first 6 months for the period under review. And at that mid-year review, the government or the minister of finance may request for additional funds, and that is what we call supplementary budget, or may revise certain expenditure items, maybe some cutoff of expenditure items due to the situations that we are in at the period or during the period under review. So what's going to be happening is that revised the mid-year results will change the original budget, which was supposed to be read and sent to Parliament by 15th of November each year, so that Parliament can approve it before the year end for the period under review. So it depends on the context of the question. If you don't have revised and you have original and actual, go with it. But if you have the three, original, revised, and actual, then your calculations will be done using the revised and the actual in order for you to make your analysis and present your case in that case. So again, it depends on the context of the question that we are solving. There could be revenue items. There could be revenue items, and there could be expenditure items, or we could have revenue and expenditure items. So, Stephanie, when we talk about budgetary analysis under the evaluation or budget variance analysis in public sector, that's what we are talking about. That's what we are talking about. Let me know if you are okay with that. Some of these things, it's when you solve questions that you see them how they are done. And we have done this in our main class, and writing the analysis is also important, because it is one thing to do the calculation, it's another thing to be able to do the analysis and interpret it. Like, for instance, I've given you two guidelines that we are looking at: the budget reliability of government. Is the budgetary system of government reliable? If government says they're going to earn a revenue or generate a revenue of, say, $10 billion, will they generate the $10 billion, or it is just something they do to, you know garnish the populace or beautify government's activities or operations generally? So it depends, but let me know if that's clear for you. Chris Chanda said, I'm Chris Zingolongo from Zambia. Kindly talk about backflash accounting. Writing Ziga examination there. Ziga examination in December. Unfortunately, I don't have a lot of material on backflash accounting, so I wouldn't be able to share my thought with you on that today. Possibly next week, during on Monday, maybe I'll be able to share a slide on that, because I don't have it set up here to be able to share anything on that. Tankoba said, "Thank you, sir. All right." Olumide said, "It's okay, sir. All right." Donko Philemon said, please, can you touch on government grants? What exactly in government grants? There's a lot of things in government grants, but what exactly in government grants am I supposed to touch on? It's a lot. There's a lot of things in government grants, but um, government grants is government grants. I mean, it's a form of assistance that is received, and we can have, you know, financial assistance from the government, and we can have non-financial assistance from the government. Usually, for the non financial assistance, they are going to be disclosed in the notes to the financial statement, but the financial assistance must be recognized and treated in the financial statements. And for those financial assistance, there are two approaches that an entity can use to account for the government's grant. We can use the deferred income approach, where the grant is recognized as a deferred income, or we can use it to reduce the cost of the assets. To reduce the cost of the assets. These are the two treatments for government grants. Now, when we recognize it as a deferred income, then it will be amortized over the economic useful life of the asset. Over the economic useful life of the asset. But if you are going to use it to reduce the cost of the asset, it means that the initial cost of the asset will be the cost minus any government grants that we have received, or the government grants that we are due to receive in that case. So I don't know which part of the grants of government's grant that you would want me to touch on, but that's the idea about that. There are two approaches available: deferred income, or they reduce the cost of the using it to reduce the cost of the asset as an alternative method as well. So these are the two available generally in that case. And depending on the method you are using and how you deal with repayments, depending on the method you are using and how you deal with repayments in that particular case. Because if it is recognized as a deferred income, there is a way you deal with repayment. If it was used to reduce the initial cost of the asset, there's a way you deal with the repayment as well in that case. So, Donko Philemon, that's the idea about government grants. Like I said, I don't know which part your challenge is, and but that is the idea about how we go through it. Let me know if that it's clear for you. What do we have? L Brown said, "God bless you, Nhyira. I was I wasn't that good in FR, but way back I started watching your video day and night before even sitting for FR last sitting. And God being so good, I passed FR. God bless you, Nhyira. Congratulations. Amen. And God bless you too. Really great to hear that you were able to pass your FR examination. That's really great to hear. Chris said, kindly help me touch on zero-based budgeting. Yeah, like the name suggests, zero-based budgeting means zero-based budgeting, It's a budgeting system where um we are starting the budget from zero, like the name suggests, from zero. What it means is that items to be included in the financial statement must be justified before they are inclusion. Okay? So only items that are justified and expected in the budget period are included in the budget. That's the idea about ZBB, are included in the budget. Are included in the budget. So with zero base, you are starting from scratch. The advantage here is that error from previous year budgets are not carried to the uh, next budget. Unlike incremental budgeting, where we use the previous year budget as the basis, in zero-based budgeting, you are starting from scratch. You are starting from zero. So in that case, errors from the previous budget will not be carried to the next budget, generally in that particular case. So we are prevented from that as we look at the discussion in that regard. Then another thing that we can also talk about in the context of that is that uh, it brings about a lot of efficiency in the budgeting system because you are justifying only things that must be included. Now, the way the zero-based budgeting works is that the organization will really look at the various decision packages that they will make. So they will look at the decision packages that they will make. Then they are going to be analyzing each decision package to find out the impact of the decision package on the organization for the budget period under review. Then suddenly, after the analysis, then they can allocate resources to those decision packages. And that is why it will then be included in the budget of the organization. So if you want, the zero-based budgeting goes through three stages. One is to design the decision package. This represents the various decisions that the entity is going to be making during the budget period. Maybe they're going to buy some assets, they're going to raise some revenue, they're going to sell some assets. Then they analyze the impact of each decision. Then they're going to rank it based on the objective of the organization. Usually they rank based on the objective of the organization. Then once they rank, they will decide, okay, this decision package is good, but we can't do it in the budget period, so let's ignore it for now. Okay, this decision package is good, but we need it as well, so let's include it in the budget. And that is the idea generally also about zero-based budgeting. So we are starting the budget system from scratch. We justify the inclusion of each item in the budget for the period under review. We do that by designing the decision packages, analyzing each decision package, and then most importantly, also allocating resources to the decision packages. And that is the only time they will be included in the budget of the organization. So that is the idea about that. Any other questions for me? Any other questions? Put it in the chat for me. Any other questions? Don Kofelemon, I see some of you guys joining. You are welcome. Give us a thumbs up on the video, and also it's a Q&A session. It's a live Q&A session, so you can throw your questions to me, and as much as possible, I'll provide you with some answers here. Don't call Philemon said thank you. All right. Please, I'm okay with it. All right, that's fine. Then Stephanie Ampofo said thank you, Nhyira. Always a pleasure, Stephanie. Any other questions for me? Put it in the chat for me as we uh go into our discussion and continue with the Q&A session. Chris said, thanks, sir. Always a pleasure, Chris. Any other questions? Put it in the chat for me. Now, it is important you understand, like I shared with you earlier, the key issues that you have to, focus on in order for you to increase your chances of passing the examination. Now, if you are writing financial reporting, you know the things that are going to be there already. Yeah, question one, it's going to be on consolidated financial statements. You know that already. That's not a miracle. Question two, it's going to be on IFRSs. You don't need a miracle on that. Question three, it's going to be on single entity financial statements. You know that already. You don't need a miracle on that. Question four, it's going to be on ratios. In that case, you don't need a miracle also for that. And question five is going to be a no man's land area where the examiner may throw some ethics, may throw some conceptual framework, and also may throw some standards, some IASs or IFRSs here. So if you're a financial reporting student, like this is the swag, you can go about it. Like you cannot ignore it. This is how your examination is going to be. But the question you need to ask yourself is, what am I supposed to look out for? Like I say always, ethics is going to be crucial. So you need to understand, yes, the fundamental code of ethics. In case you have a problem with that, you can check our channel. We have videos on the fundamental code of ethics that will assist you. If there are any questions, please put it in the chat for me or the comment section for me. Something you would want me to specifically share my thought on and to assist you, put it in the chat for me. I would want to hear from you and assist you as we get into it in that case. So, yes, you must understand the fundamental code of ethics, but beyond that, you must understand the threats to the fundamental code of ethics: self-interest threats, self-review threats, familiarity threats, intimidation threats, advocacy threats. You must understand them. But a key question is, how do you write out your answers? That is very crucial. That is very crucial, because sometimes the examiner will ask you, okay, what is the ethical issue in the question? Sometimes the examiner could ask you, how should the accountant act? How should the accountant act not to breach the code of ethics? Now, you have to be careful because, yes, even though they are all about ethics, the way you answer the question will be a little bit different. So if the question says, oh, what is the ethical issue in the scenario? That's okay. Or the question said, how should the accountant act not to breach the code of ethics? Then you got to be careful about that. And this applies also to corporate reporting students, because in corporate reporting, we know there's going to be a question on ethics in corporate reporting as well. So either the ethical issues or the code of ethics, or the examiner can say what threats the accountant is facing. The threats that accountant faces in the scenario. Please stay with me carefully. Stay with me carefully. If the examiner should throw the question at you, what is the ethical issue the person is faced with? Usually, your answering will take this form. ethical issues that accountant is facing. Usually, you would have to look at the scenario, okay? Understand the main issues in the scenarios, in the scenario given. Two, you must then identify the threats that a person is faced with. Then you can connect it with the code of ethics being breached. Likely to be breached. So let me give an example so that you understand what the heck we're talking about here. So let's say, for instance, Stephanie. So let's say Stephanie is the accountant of the company, and she's a newly qualified accountant, chartered accountant for the company. Then we are told that the CFO of the company has said that if Stephanie wants to be in the job, for she's a newly qualified accountant, and she's also newly employed by the company. Let's say, as a matter of fact, she's on maybe probation, whatever they call that. So she's not permanently employed. I mean, she's awaiting permanency. Then the CFO tells Stephanie that, hey, Stephanie, if you want this job, make sure that you prepare the financial statements to have a strong position for us. So we want a strong financial statement because we are going for a loan. So let's just use this as a guinea pig to answer what is going on. Please stay with me carefully. So Stephanie is newly qualified chartered accountant. She has been employed by the company, but she's sort of on a probation, so it's not confirmed yet. But the CFO is telling Stephanie, because she's preparing the financial statements, the CFO tells Stephanie that, hey, we want a strong financial statement because we are going for a loan. Now, what's going on here? What's going on here? Stay with me carefully. Stephanie, being someone who is newly qualified, okay, newly qualified chartered accountant, or recently qualified chartered accountant, means that even though she possesses the knowledge, she lacks the experience. Okay, lack of experience, because she has not prepared any financial statements. This is the time she has become a chartered accountant, and she's being asked to prepare financial statement. So she has the knowledge, but she lacks the experience. She may even lack the skill of preparing financial statements, because all she's been learning is about single entity and all that. But now she's being told to prepare a financial statement. So she lacks the experience. If someone lacks the experience, that means that she is likely not to do the work in a manner that is expected to be done. And so she's likely to make wrong judgments. So the lack of experience will affect her professional due care. The manner in which a financial statement is supposed to be prepared, she's not going to be preparing it that way. And objectivity is likely to be affected as well, in the context that she doesn't have a lot of experience, and so her professional judgment could be a little bit whack. So lack of experience, being a newly qualified accountant, can be something that would affect her. Two, she's newly employed. In this day and age, who wants to lose her job or his job? No, she doesn't want to lose that. So, she's connected with a job. She would want to have permanent employment. And there is a promise on the line for permanent employment. So, promise by the CFO for, a permanent employment will expose her to what we call a self-interest threat. Because she wants to keep her job. She wants to keep working for the company. She's a chartered accountant. She doesn't want to be in the house and be selling yoi or be selling water. I don't mean that if you're selling water, it means you are You don't have head. I'm just giving an example, okay? So she doesn't want to be in the house and be selling yoi or something else. She want to be in the field. She want to be in the corporate world. She want to do what she has been trained to do. So because of the promise to get a permanent employment, if she does what she's been asked to do, it's a self-interest threat. And that is self-interest threat will cause her to not be too objective. So her objectivity is going to be impaired. Then it may cause her to present misleading financial statements. Remember, the financial statements it's going to be used for a loan. So she's going to prepare misleading financial statement to the bank. And that is an impact on her integrity as a professional accountant. Are you getting the way I'm writing out the answers? So it follows the principle here. The main issue has to be stated in your answer briefly. Please don't write AC. It's not that you are writing the whole case study in your answer. Tell us the main issue. So look at the way I'm bringing it up. So you talk about the main issue, then that main issue that you have seen, what threats is the person exposed to, and what code of ethics is the person breaching? So the promise by the CEO for the permanent employment exposes her to a self-interest threat because she would want to do everything to keep her job. Then the finance director is saying that, hey, we need a strong financial statement because we are going in for a loan. Remember, Stephanie is newly employed. She is newly qualified. And so she may be under obligation to please her boss. And that could amount to intimidation threats. That could amount to intimidation threat. Okay, the undue pressure. So because she's newly employed and because of the promise and the fact that she would want to please the CFO so she gets the job, she may be under pressure to satisfy the boss. So everything the boss says, even though Stephanie may know that boss, what you're saying, it's not true. What you are saying, it's not right. She may not do it. That's the idea about how, and that intimidation threat will definitely affect her integrity, will affect her objectivity, could even cause her to behave in a manner that she's not supposed to behave. And so professional behavior could also be on the line. That is the idea about, if the question talks about what is the ethical issue, what is the ethical issue? So always the main issue, always identify the threats, always the code of ethics likely to be breached. And it is important you write your answer in that manner if you want to get all the 6 marks, or if the examiner is excited, all the 10 marks. Any questions? Any questions for me? I see some of you guys coming up. Any questions for me? This is a live Q&A session, and I'm sharing some thoughts with you also on how to answer the various questions that the examiner will be presenting to you in the exam hall. So put your questions in the chat for me, and I will answer them. Let's see. I'm seeing some comments coming in. Talk about advanced variance. When you talk about advanced variance, you've not said anything. Maybe tell me something specific that you would want me to talk about. Ali Ibrahim said, hi, hello, Ibrahim. Stephanie Ampofo said, can you do same for FM and PSA, exam structure and key areas to look out for? Okay. Let's see if we can do something on that. So public sector accounting and finance also, we know what is going to be there in the exam hall. You know that already, unless you're a lazy student. Question 1 is going to be based on, conceptual framework. Conceptual framework for general purpose financial reporting. That's question 1. It's going to be there. All right. And some introductory issues, depending on how excited the examiner is. Question 2, depending. Question 2 may be on issues relating to, maybe let me cross check that. Give me a moment. I should have my slide here. Let me just go to the examination analysis document for PSA. And let me confirm what's question 2 usually it's going to be. Question 2 will be on, okay, preparation of financial statements. Okay. So question 2 may be on preparation of financial statements. Please do not focus on anything, because the examiner can ask you to prepare financial statement for the consolidated fund, that is the central government consolidated fund, or you can be asked to prepare financial statement for a ministry's department or agency, or a metropolitan municipal and district assembly. So it depends. Or other covered entities. It could be a hospital, a school, a public transport company. So other covered entities. So your best bet here is that you must understand a key topic in the public sector called revenue management and expenditure control. This topic is your secret topic to help you ace the financial statement preparation. In addition to that topic, the IPSAS, you have to understand the IPSAS very well. Depending on the context of the question, IPSAS 16, sorry, IPSAS 17, property, plant, and equipment. You have to know that, because usually some depreciation situations will come in. Then maybe IPSAS 12, inventory. Okay, and there are other IPSAS depending on the context of the question. There is IPSAS 9, revenue from non-exchange transaction. There is IPSAS 23, revenue from, no, IPSAS 9 is revenue from exchange transaction. IPSAS 23 is revenue from non-exchange transaction. And these will be things that may be in the footnotes that you would have to use the knowledge on that. So that is going to be question 2. Usually it depends. Question 3 may be on evaluation of financial statements. And PIFA. Remember, PIFA has become something crucial in public sector. So almost always the examiner will bring something on PIFA in the exam hall, and you have to be mindful of that. You have to be mindful of that. So evaluation of financial statement and PIFA, this is where what I discussed earlier, you asked earlier, either we will have a common size or ratio analysis, or budget variance analysis. All these have been asked by the examiner. So again, don't go and try to be smart and say, oh, last semester the examiner asked this, so this semester he will ask this. He has asked all the 3 over the last 5 or 6 examination dates. So don't focus on anything. Make sure you understand the principles, because each of them has its own peculiar treatment and interpretation that you need to understand. Question 4, it's going to be on public-private partnership and public procurement. Usually, public-private partnership and public procurement. Then question 5 will be no man's land. I call it no man's land because, I mean, literally, everything else in the syllabus, like the roles of public officers, users of financial statements, the role of institutions like parliament, audits, public accounts committee, internal audit agency, and all that, no man's land could be thrown in there. So with public sector, that's basically the idea about the structure of the exams and what you need to, know about. Yeah, there are, key issues on what the question 1 is going to be covering. There are about 5 issues there that a question 1 is going to be covering. But as you are going into the exam for public sector, there are a couple of acts that you must be mindful of. Let me bring my slide and then just show you that here. Let me make this one bigger so you can take a screenshot of it. These are the key issues you have to pay attention to and focus on. So you can take a screenshot of it or something like that. The Public Procurement Act, 10 marks is coming from there. Public Financial Management Act 2016, Act 921. there could be more than 20, 25 marks coming in from there. The Public Financial Management Regulations Act, that will be referred to if we are going to prepare financial statement for covered entities. Public Private Partnership Act 2020, Act 10, 39, depending on the context of the exams, maybe that will come in, but we know PPP will be there for 10 marks. Then the IPSAS, you must know about the IPSAS. I've listed some of them, but you must know them well. Then the conceptual framework for general purpose financial statement, I've told you about that. Then the PIFA, I've also told you about that. That is going to be very crucial in the exam hall. Then the key topic that I mentioned also earlier, public, revenue management and expenditure control. So these are, I mean, things. There are other details. So there are other detail that may come individually under some of these things, but I can't give out everything like that. Uh, but that is what I can say, because our examination analysis document, we've shared it in detail with our students here. But these are the structure of the exams. But there are some detail issue under each of these things, but not everything I can share with you here. So that is the idea about that. Then I think you said financial management. Technically, for financial management, everything in the financial management will be there. I've said this. I said this on Tuesday. Was it on Tuesday? On Wednesday, sorry, when we had a stream. There is going to be a question on business finance. Business finance is in two folds: sources of finance, and then cost of capital. It's going to be there. Cost of capital, there is cost of equity. Under cost of equity, we have the dividend valuation method. We have the capital asset pricing model. You must know these things. Then we have cost of debt. We have the KD before tax. Then we have KD after tax. Okay. Then definitely we will have the weighted average cost of capital and all of those things coming in. Remember that the capital asset pricing module, we could have the asset beta or equity beta to be geared and re-geared and all of those things in that particular case. So it depends on the context of the question, but there is something in the exam all waiting for you on business finance. It's there. Then business valuation, it's going to be there. It's a done deal area. So you must understand the various valuation methods: the asset-based valuation method, dividend yield, earnings yield, PE ratio, the cash flow method as well. I mean, there are a lot of methods there that you need to understand. So there's something on business valuation waiting for you in the exam hall. So you must understand the methods of valuation and know the principles that underline each of them. Each of these principles, each of these models have their principles that you must adhere to. And if you screw up the principle, then you're going to screw up the results generally in that particular case. So that is the issue. Business valuation is going to be there. Which method will the examiner ask? He has asked all the methods in the last 5-6 examination dates. So your best bet is to know all of them. So don't try to pick and choose. Don't try to favorite, say, oh, I like this one, I don't like this one. No, you've got to be specific and understand everything there. The most important thing is knowing the principles that underline each of these topics so that you increase the chances of passing the examination. Then certainly working capital management. I mean, it's a broad area. Working capital management approach. The working capital management approaches, we have the conservative method, we have the aggressive method, and then we have the moderate method available. You must know them very well. Then we have management of trade receivables, management of trade payables, management of cash, and management of inventory. Very, very important. You must understand all of these guys, because the examiner can come from anywhere. Really, the examiner's favorite has been on trade receivables and a little bit on inventory situations. But you got to understand all of them to position yourself to ultimately pass the examination. So business finance, business valuation, working capital management. There's going to be a question on risk management, certainly. Risk management, certainly. The way our Ghana city is dancing and interest rates are skyrocketing in the country, there has to be ways and means to hedge uh, the entity against negative movement in the exchange rate or negative movement in interest rates for the entity or for the country under review. Sorry, for the entity for the period under review. And with the hedging methods, we have the internal methods and then the external methods, like the money market hedge, like the currency features, like the what else do we have? The forward contract and all that and all that. So there's something on risk management that is going to be there. You better know about it pretty well. Then suddenly, investment appraisal. You cannot forget that guy. There's something on investment appraisal. So in other words, what I'm trying to say is that the financial management, each key topical area, there will be question there. There will be question there. And that is the objective of the examiner. He tries as much as possible to spread his wings so he can get questions coming in from various part of the syllabus. So investment appraisal, you have to understand the methods of evaluation. You must understand sensitivity analysis. You must understand the asset replacement cycle. Then you must understand lease versus buy. Which option will be better? Then you must understand the capital budgeting process. These are the 5 thematic areas when it comes to dealing with investment appraisal. Then certainly the introductory issue, financial environment, uh, stakeholders, and those things, and those other introductory issues in the chapter 1 or chapter 2 of your book will be there. Are you getting it? So, for instance, that's our financial management book. I think the first and the second chapter, that is the financial management functions, the economic environment, the role and impact of regulatory environment, the financial markets and institutions, stakeholders, and their objectives. So that's introductory aspect of financial management. Some questions will be coming in from there. It's a lot. So even though there will be questions coming from there, the reading there, it's a lot. You want to not spend a lot of the time on that, but make sure, because investment appraisal has a lot of workings, and reading also there. Risk management has a lot of workings. Business finance, cost of capital situations, a lot of workings there. Business valuation, a lot of workings there. Working capital management, also a lot of workings. So probably you want to really spend your time to understand the principles there, so that you can cruise a little bit reading through those theory areas at the beginning of the book. But give and take, you're going to be having some 10-mark question coming in from there. Okay, Stephanie. So that is the idea about financial management. That's the idea about financial management. Let me know if that is helpful for you and that makes sense to you. What do we have? Planning and sales variances. Uh Again, still I don't get a context, but let me see if I can talk about this. Now, when it comes to the sales variances, usually we're going to be calculating two. We have the sales price variance and then the sales volume variance. You need to be mindful when calculating the sales volume variance, because it depends on the environment that the company is in. If the company is in the marginal costing, or the entity is using marginal costing system, that means that we will be interested in the standard contribution. We'll be interested in the standard contribution. But if we are in the absorption costing system, if you're in the absorption costing system, they will be interested in standard profit. If the question is quiet, we may assume that the company is using the absorption costing system. So depending on the system we are in and how the sales volume can be calculated. can be calculated, because the idea about the sales volume is simply to bring your budgeted sales and your actual sales. The difference will give you, or the balance will give you the difference, and that could be favorable or adverse. For instance, if we are dealing with how do we call it? If the budget is more than the actual, that is an adverse variance, because you had sold less than you budgeted to sell. But if the actual is more than the budget, then it means it's a favorable variance. Now, this difference is in units, but you always need your variance in currency. So you have to multiply by standard, either standard profit or standard contribution, depending on the system that the organization is using. That is what I was trying to tell you here. Depending on the system the organization is using and what we are going to be using, or what we are going to be doing generally in that particular case. That is the idea about that. Now, where the company sells more than one product, then usually we're going to calculate the sales volume variance. Where the company that sells multiple products, then the sales volume variance may be divided into the sales mix and then the sales quantity variance. The sales mix and the sales quantity variance. So if you talk about the sales budget or the sales variance, that's what you have to understand. Like I mentioned, the issue is to know which environment the company is in, especially on the sales volume variance, to be able to know exactly what you are supposed to do for that aspect. Stephanie said, thank you, Nhyira. Okay, you're welcome. Kenny Manya said, greetings from my side. Your YouTube channel is a great help. I bought the textbook through Amazon and it is very helpful. Response from WhatsApp, it's a bit slow, but I can understand the busy nature. I don't know. If you send a message on WhatsApp, certainly my assistant will be able to assist you. Okay. Thank you for that. Okay, so you got the book on Amazon. That's great there. It says, hi, Nhyira, I hope I'm not late. It's a Q&A, so, late. Atabwat Engineer said, briefly touch on the report writing on accounting ratios. So in the evaluation of the financial statement, sometimes the examiner will ask you to write a report. So it is very important for you to follow the pro forma and understand how a report is supposed to be written. So we will be doing from whom? You. So maybe two first. Let's bring two. Who are you writing to? Maybe we are writing to management, we are writing to shareholders, maybe we are writing to whatever, the board, or whatever the heck. From whom? You. The examiner will give you the context of who you are. If it doesn't give you the context, you can call yourself a financial analyst, or you can say ICAG, level 2 or level 3 student, or whatever the heck. What is the subject you are writing on? Analysis of the financial statement. Then you can have your dates coming in, putting the dates down. Then you have your introduction paragraph. You write introduction. Now, your introduction paragraphs should briefly talk about the purpose of the analysis, or if you want, the objective of this report. Okay, it should also talk about the basis of comparison. Maybe we are comparing the financial statement of the entity to industry average, or we are comparing the financial statement of the entity current year to the previous year, whatever the heck it is. Then you need to talk about probably the year ended and other issues. Maybe the examiner said provide other issues. You can talk about it. Okay, that's your introduction. So after the introduction, you can now pick the items one after the other. Usually you will go to the second paragraph, and that will be financial performance. So this paragraph is where you're going to be explaining the various profitability ratios. The various profitability ratios will be explained here. Then you go to financial position. So this is where you're going to be interpreting your liquidity and gearing ratios, if there is any. Liquidity, gearing, and other efficiency ratios could be explained here. When you are done, you have a conclusion paragraph. In your conclusion paragraph, you need to talk about the overall performance of the entity. Then you need to talk about any recommendation that you make for them. Then maybe other issues that the examiner wants you to talk about. Okay, so to, from, introduction, write introduction. Financial performance, write financial performance. Financial position, write financial position. Interpret the respective issues under that. Then conclusion. Conclusion paragraph will talk about the overall performance of the organization for the period under review that we're talking about. So you put it up and then bring it in that regard. Once you are done, you finish it up. Yours, whatever the heck, yours faithfully. Put your signature up, write your name, Nhyira Mbamba. Then whatever, you go away. So Ata Boateng Jr., that's how the report is supposed to be. Now, professionalism is very key. So the pro forma will be marked before the context of your, interpretation will even be looked at. Before the context of your interpretation will be looked at. So that is the idea generally about report writing. Let me know if that is okay for you. Chris said, thank you, Nhyira. You're helping me a lot. Okay, that's great to hear. Any other questions for me? Any other questions for me? Let's see. Did I skip anything? Then Donko Philemon said, please touch on IFRS 16. What exactly in IFRS 16? When you make it blank like that, it becomes bebre, because am I supposed to teach everything? What exactly in IFRS 16 that I'm supposed to talk about? Right? Because IFRS 16 is about leases. And generally, if we are going to be talking about the lessee accounting, there are two approaches that are available. We have the default approach, and then we have the alternative approach. But remember that we can only recognize lease when the entity controls the asset, controls the usage of the asset. That's where we can recognize it as a lease contract exists, and also that the significant future economic benefit from the asset flows to the entity. Are you getting it? Now, when we say the entity controls the usage of the asset, it means the entity controls the usage of the asset. So in a question that involves leases, we must establish, especially the first point, but the two must be established. We direct the usage of the asset or control the usage of the asset, and significantly, future economic benefits will flow to the entity. If that is the case, then we can recognize lease. So in that case, what is going to be happening is that the lessee would debit right of use asset, ROU, and it will credit lease liability. That is the initial measurement. But there are a lot of things that goes into is what figure will we use for the right of use, what figure will we use for the lease liability. That is why I was asking, like, which part of lease do you have problem with? Because it's a lot. You can watch our video on the portal under leases. We did a master class on that on the portal. Sorry, on the YouTube channel here. It's also available in our mobile application. Alternatively, the standard says that if the asset is a low value asset, okay, so if we are leasing a low value asset or the lease term is short, then the entity can decide to treat the transaction as rentals, as normal rentals. In that case, that means we won't recognize any assets. We will just debit profit or loss with the rent payment or the lease payment once it becomes due, and then we credit cash if we have paid it. If we have not paid it, we're going to credit liability on the face of the statement of financial position. So if the asset is a low value asset or the lease term is short. Now, what is a low value asset? It depends on the entity, because an entity may see an asset as a low value, another entity may see the asset as not a low value. So let's say, for instance, I'm just going to use an example. Let's say EcoBank. EcoBank, maybe they have printers and they are leasing the printers. Okay, so give and take, let's say the printer on the average, let's say it's 40,000 Ghana cedi, and they are leasing it because for tax purposes, it is advantageous to lease rather than to outrightly buy some assets in that case. So they may want to lease the assets. So in their books, if you look at EcoBank Ghana, they may consider the 40,000 cedis to be a low value asset. So they would just deal with it as a normal rental. So they wouldn't have to recognize the printer in their financial statements. They may not do that. That is called a low value method. But that same printer, if we are dealing with another business, maybe some small business somewhere, and they are leasing that printer, they may consider it as a high value. So whilst EcoBank may be considering that as a low value, another company may be considering that as really a significant asset. So they would rather use the default method to account for the printer. So it's about choice. And management is left with the judgment or the decision on which alternative is appropriate. Okay. There are other issues, like I said, this is a whole discussion that we can talk about. There is what must be recognized in the right of use. What are the elements that goes into the determination of the amount for the right of use? What element goes into the determination of the lease liability? All these things, you have to understand them. So you can watch our full video uh on the YouTube channel on IFRS 16 is one of our popular videos on the channel, and you can watch it. It's a two-part video on leases, and to really help you to answer some questions that you are having when it comes to dealing with leases. Okay, so that is it about that. Okay, so for timing purposes, or for time constraint purposes, I'm going to be wrapping up around here today. But Monday, I'm going to be coming your way again, and we'll continue with this Q&A so that I can, provide you some topical uh, assistance in some of the things that you are learning. I'm seeing a question coming up. Can you kindly touch on capital asset pricing module? I'll do that on Monday because I have a class, I have a financial reporting class pretty soon, and I have to just organize for that as well. So I'm going to treat this on Monday when we come. So Monday, I'll be coming your way at the same time, 4:30 p.m., and we'll continue with the Q&A whilst I provide you with the blueprint on the key areas you have to focus on, how you are going to be answering the questions. Because, like I say all the time, sometimes people pass the examination not because they don't know, but because of the way they are answering the question. And yesterday I had an interesting time in the class with our advanced audit and assurance students, and it was interesting because yes, they are writing, you may be writing something that you think that is the answer, but it's actually an idea. It's actually an idea in that case. So it is important we know the fundamental principles, but also equally important for us to be able to know how to write out our answers, and then even how to study the topics together to increase our chances of ultimately passing the examination. So I'll be coming your way on Monday so we can continue with the discussion. Silence Dodu said, foreign exchange risks in FM. Like I said, I would have to touch on these things on Monday, but I'm going to write it down. Foreign exchange risk. Then I'm having another one coming in. Can you please explain how to calculate weighted average cost of capital? I'll talk about that also on Monday. So on Monday, I'm going to be coming your way, okay, around the same time, 4:30, and we're going to be providing you with some assistance, helping you to answer specific questions so you can prepare well for the examination. All right. Remember, you can download our mobile application on the Google Play Store or the App Store. You'll get access to, a lot of videos available, a lot of videos available on the in the application, a lot of free videos available in the application. Then you get access to also some post video notes as well that will help you to do your revision and be able to pass the examination. So that is it about that. And I'm going to wrap up around here. Thank you very much, guys, for joining me. Really excited about it. Samuel Kofi Villali Evans upon George Champon, Nick, Peter, Kofi Steve. Thank you very much for the thumbs up on Facebook. Really appreciate it and the sharing. And for those of you who are giving us a thumbs up also on YouTube, really appreciate it. Thank you very much. And I'm going to wrap up here. Have a great weekend. Continue to study, and we will return on Monday with the same session to find out what we can do to assist you in order for you to prepare well for the examination. But most importantly, become successful. Stay safe and take care of yourself. Bye bye.